It has been a sad end to 2023 with the passing of one of the investing goats, Charlie Munger. As Warren Buffett's right-hand man, and perhaps the more outspoken of the two, he was well respected in the industry for sticking to his value investing principles and of course made his billion-dollar fortune doing so. In this video, I'll be unpacking 6 key investing principles shared by financial advisory firm the Motley Fool that I think offers an excellent roadmap for anyone wanting long-term success in the stock market. From diversification to holding through market volatility, we'll explore why these principles are the cornerstones of successful long-term investing, just like Charlie Munger. Before we dive in, please make sure to subscribe to my channel down below. I post a lot of content in the personal finance and investing space, and that allows you to keep up to date with all my latest content. The first investing principle is to buy at least 25 stocks. It's like assembling your very own dream team of companies, like the Avengers of the investing world. But you might be wondering, why do you need at least 25? In the investing world, this is called diversification. Think of the Avengers for a moment. Every single member has their respective set of strengths and weaknesses under different scenarios or environments. Stocks are no different. Their superpowers lie in their industry, their geographies, their leadership, their products, their reputation, a range of factors that could see them either perform or not. The more superheroes you add, or stocks in our case, the more diversified and resilient your portfolio becomes. If we take Boeing as an example, they operate in a duopoly market, so their business is quite strong. When COVID hit, however, they saw plane orders dry up, and their performance saw them take a massive dive. A portfolio with just Boeing stock would have been extremely vulnerable. If we had also added some Tesla shares to our portfolio, which operates in a completely different industry altogether, our portfolio wouldn't have been affected as badly. The Avengers are better as a group, as when one is weak, the others step up. Stocks are much the same. To purchase these 25 stocks, you can either buy these directly through your broker, like Sharesies, or you can invest in a broad-based ETF or fund like Vanguard, Kernel, or State Street. Now, the second investing principle is to hold your stocks for 5 years or longer. In the investing world, the old saying, slow and steady wins the race, is not far from the truth. Charlie Munger and Warren Buffett, for example, have built their billions over a lifetime through what's called the compounding effect. As a strategy, this is called the buy and hold method. Resisting the siren call of quick wins or cutting losses allows time for companies to work on your behalf and grow the value of your holdings. If you chose the companies well in the first place, there might be some short-term price fluctuations, but its potential may take a bit longer to shine through. If we look at Tesla, for example, we can see that for 10 years, the company's stock barely moved. Since 2020, however, the stock price has nearly appreciated 10 times over. So give the company time, and if you picked well, eventually the price should follow. So we've covered the investing terms of diversification, compounding, and buy and hold. The third investing principle is to invest new money on a regular basis. In the investing world, we call this dollar cost averaging. This is where every few weeks or so, you reinvest into the stocks that you already own. This is important as it allows you to not only buy a larger stake in the company, but if the price goes down, introducing new money allows you to acquire new stock at a discount as well as bring down your average cost per share. When the price rebounds, because you followed the second point to invest over the longer term, the stock price doesn't need to increase by as much to break even. Superannuation schemes are no different, as you need to contribute with every paycheck. Even small amounts are useful, as these have a snowball effect for your portfolio. As that snowball continues to roll downhill, it keeps gaining size and momentum. To put this into action, there's a few things that you can do. First is to invest directly into the shares when new funds are available. Second is to check whether your broker allows you to do auto invest. Here in New Zealand, you have Sharesies, Kernel, Invest Now, among many others that allow this. And third, some shares have a dividend reinvestment program where your dividends are automatically reinvested into company stock. Now we're halfway, and our fourth investing principle is to hold through market volatility. We've lightly referred to this in our first 3 points. In the short run, shares can be volatile. Prices can fall by as much as 30% in a single year. While market declines aren't popular, of course, your two best options are to either ignore them or to use these times to your advantage. When the market experiences such volatility and prices fall, it is an ideal time to buy more of your most promising stocks. The most important thing to remember with this point is to not panic sell during volatile times. We buy and hold over the long term, have a diverse mix of stocks to get us out of the rut, And if we introduce new money, we can get stock at a discount and they don't need to appreciate by as much to break even again. If we look back to 2020, many investors panic sold their stocks at the bottom of the cycle. This meant that they missed out on some tremendous returns throughout the rest of 2020. Now we've reached our fifth investing principle, which is to let your portfolio winners keep winning. History tells us that winning stocks tend to keep winning over the longer term. Cashing out early can often pale when compared with the returns over holding winners for the long run. Apple, for example, has been winning for at least the past 10 years. This can often be a downside of investment funds or ETFs, as they have target allocations for stocks, geographies, or industries that may result in them selling down their winners to bring them back in line. While that may be true for S&P 500 funds, others such as QQQ have benefited as they have a heavy focus on tech stocks which have performed well in recent years. And finally, we have our sixth investing principle, targeting long-term returns. This point covers almost every point we've covered in this video. In the short term, of course, anything can happen. Stocks can rise 100%, or they could even fall by about as much. As investors, we should always focus on achieving excellent returns over a 5 to 25 year period. Stock investing is a long-term game that is best played over a lifetime, as we saw in the case of Charlie Munger. By investing small amounts on a regular basis into a diverse group of at least 25 stocks, we can ride the waves of volatility in the market, and over time we'll see our portfolios grow. To round out the video, I want to relate these 6 investing principles to common investments we all have, superannuation schemes. Our first point we covered was to invest in at least 25 stocks. Superannuation schemes commonly have allocations into stocks, bonds, fixed income, and even property investments. Within each of these, they could invest in as many as thousands of individual companies and fixed income instruments. The S&P 500 fund has 500 companies alone, of course. Our second principle is to hold stocks for 5 years or longer, which is similar to our sixth point to target long-term returns. As our superannuation funds are locked away until retirement, the providers literally force us to invest over the longer term, because only then can we benefit from the true power of compounding over a lifetime. Our third investment principle is to invest new money on a regular basis. In New Zealand and Australia, contributions to our superannuation funds happen with every paycheck. This is the best practice to set up passive mechanisms to invest using best practice without having to think every single time you invest. And finally, our fifth point is to let the winners continue to win. Superannuation funds can be less useful here, as funds commonly sell down your winners to stick to their rigid investment allocations. Here in New Zealand, Sharesies has recently introduced the new Kiwisaver fund, allowing you to invest directly into individual company stock. If you truly believe in a company, this might be something to look into. I hope you enjoyed this video. If you did, please make sure to subscribe to my channel down below to keep up to date with all my latest content in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.